Welcome to another edition of Wealthy and Wise Wednesdays, where I share a few words of financial wisdom to help put you back in the driver's seat of your financial future. Today is Wednesday, May 5th. Thanks for joining me. And there's so much happening today. Just yesterday, the markets had a terrible day. Red almost all across the board, everything going down. Most of the stocks, the funds, even precious metals going down on fears of inflation, on fears of higher taxes. And that's why I do this series of Wealthy and Wise Wednesdays. This is why I put out blogs. This is why I share information and graphics on social media, is to help you, the average middle-class person, gain a little more financial education, a little more financial wisdom to help you in your lives. Because I think that many of the people who tune into these videos, they're patriots, they're about free markets, they're about freedom. And part of the freedom in our lives also has to do with having control of our money. It's about financial freedom. And a lot of that has to do with financial education. And so when I do these blogs and when I do these videos, of course, it is for informational and educational purposes. It is not to be taken as specific or personalized financial advice for you. But a lot of people who they see these videos and they see the things that I post, they do contact me. And then we're able to continue that conversation and apply these principles specifically in their lives to their specific situation. So just kind of a note there. So I'm glad that these videos and the content that I'm putting out, it is helping people to gain more knowledge and inspiring them to take action with somebody that they can trust. Now, today, let's jump into the topic that I want to talk about, and that is Joe Biden's tax plan and 12 potential changes that we need to keep our eyes on. He's used the budget reconciliation process to push through the recent COVID-19 relief package, and that's a powerful avenue that's only available once a year. Well, the next federal fiscal year begins on October 1st, 2021. And so that budget reconciliation, it's going to become available again. President Biden, he has a Democrat-controlled House. The Senate has the tiebreaker being his vice president, Kamala Harris. And so they're going to have the opportunity to press forward with a lot of the proposed changes to tax laws. Now, such changes will likely come into effect next year for the year 2022. But some of these changes could vastly complicate things that you have going on in your financial life, in your financial planning. So I just want to talk about some of these things here. The key potential tax changes that we should keep an eye on. Number one, and this probably isn't going to apply to most people. I know sure as hell it doesn't apply to me, but it's reducing the federal estate gift and generation skipping tax exemption from $11.7 million, way up there right now, and bringing that down to $5 million. Or I've seen some estimates go even as low as $3.5 million. That's imperative that clients who are using this exemption to take these potential changes into consideration and restructure their legacy planning to ensure that they're not subject to a large federal gift tax if that reduction does indeed go into play. It's also possible that the federal estate tax rates could be increased on some sort of graduated scale from the current 40% rate up to as high as 77% on the larger, extremely large estates, I should say. But 77% federal estate tax on the largest estates. Number two, eliminating certain discounting techniques, discounting from the market value of limited liability partnerships or corporations due to minority interests, lack of marketability, so on and so forth. They've been very effective in the past to be able to reduce such asset values as much as 30 or 40% for gift and estate tax purposes. We may also see substantial cutbacks or elimination of discounting techniques, such as deferred gifts in trust, such as the grantor retained annuity trust, charitable lead annuity trust, and the charitable remainders trusts. And by the way, as I'm going through this, I should mention that this information is based on an article from wealthmanagement.com. So I've got that pulled up here, kind of using it as a guide, going through these 12 points, and I'll link it below at the end of the podcast today. Third one is taxing the grantor trusts in the grantor's estate. Currently, such trusts are considered owned by the grantor for income tax purposes, but at death, these trusts are not includable as an asset in the grantor's estate for estate tax purposes. So that's on the table, something that may be changed. Fourth, and this is a big one because this is something that affects middle-class people like you and me, and that is they're discussing eliminating the step up in basis at the time of death. So currently, the taxpayer's unrealized capital gains at time of death are not subject to capital gains tax, and the beneficiaries of the estate receive a new basis in those assets equal to the market value at the time of death. And what that means, for example, is let's say that over the course of my life, I had invested $150,000 into various stocks, let's say. And over the time of my life, my $150,000 investment grew to, let's say, $400,000 at the time of my death. So if I were to liquidate that account, I would owe capital gains tax on the gain. I would owe capital gains tax on the $250,000 of growth within that stock portfolio. However, if I were to die without liquidating that account, that $400,000 would then pass to my children without any losing the microphone. That would pass to my children without any capital gains tax due. So let's say it passed to my oldest daughter. She would not owe capital gains tax on the $250,000. Her cost basis would step up from $150,000 up to $400,000. So that would eliminate her capital gains tax liability at the time of my death. They're talking about doing away with that and making the capital gains tax, implementing it upon her when she receives those assets. And then furthermore, if the asset is depreciable, such as a real estate portfolio, the beneficiaries can take depreciation deductions based on the new stepped up basis. So we may see an attempt to revert this carryover basis concept where the beneficiaries receive the assets in the same basis that the deceased had. And then another proposal is that the federal estate tax would be eliminated in favor of recognition of all capital gains at the time of death. They actually use that system currently in Canada. Kind of want to speed up here a little bit and get through this. Fifth, limiting the generation skipping exemption to a specific term or specific number of years. Six, reducing the gift tax-free annual exclusion. Currently, a taxpayer can make tax-free gifts of $15,000 to as many individuals as they want. Let's say that grandma is 80 or 85 and she has a significant amount of money in an IRA or in the bank, something like that. And she just kind of figures, I'm not going to use all this money. Why don't I give this away as gifts to my children or grandchildren so I can do it now and watch them enjoy it while I'm still alive? Well, she could give $15,000 to grandchild number one, another $15,000 to grandchild number two, another $15,000 to grandchild number three. And she's got 10 grandchildren. She could maximize that $15,000 gift tax-free annual exclusion to as many people as she wants, really. Spouses can join in on the gifts. So if grandma is married, if grandpa hasn't passed away yet, they can do $30,000 per donee. So the new proposals under consideration would cap the gift tax exclusion to be used each year, make a total of maybe $20,000 a year total or $50,000 a year total. That would cover all 15 of those grandkids. Maybe it would be 20,000 total or 50,000 total. Seventh, increasing income tax rates for higher earning taxpayers. The current 37% rate is proposed to be moved back to 39.6 on a graduated scale. Additionally, for upper tax bracket taxpayers, the long-term capital gains and the qualified dividends, there's a preferred tax rate right now. So even the higher income earners, their capital gains tax rate, much more favorable than ordinary income tax rates. Right now it's 20%. So that's about half of the income tax. Again, capital gains tax is different. That is selling and realizing the gains on an appreciated asset. That's not income. So the income tax rate right now for high income earners is 37%, but the capital gains tax rate is much more favorable at 20%. Well, they're talking about getting rid of that preferred capital gains tax rate and preferred dividends and just taxing everything as ordinary income, which in effect, that would basically double from the 20% that it is right now up to the 39.6%. Number 8, capping the benefit derived from income tax deductions. And for these upper income taxpayers, eliminating up to 80% of their deductions. 9th, broadening the 12.4 Social Security tax, which is currently imposed on compensation of income up to $142,800 to encompass, they broaden that to encompass all such income in excess of $400,000. 10th, if I've got any real estate investors watching this, because I know I've got a lot of real estate friends, you're really going to hate this, but they want to eliminate the tax-free exchanges of real estate under IRC section 1031. So those tax-free 1031 exchanges where basically you would sell a smaller property and then roll that profit into a new, larger property without paying any gains on the home. So for example, if you bought a rental property at $150,000, held on to it for several years, and then it appreciated up to $250,000, well, when you sell that, you do not have to pay that $100,000 of gain if you're rolling the $250,000 purchase price into the purchase of a larger or a new real estate investment. So maybe you're kind of like going back to Monopoly. Maybe you're selling a few houses and then you're buying a hotel or an apartment complex or something like that. Well, using IRC 1031, you can do a tax-free exchange using all of your profits from your previous sales, rolling that into a new sale. They're talking about getting rid of that. They're also talking about getting rid of offsetting taxable gains by investing in the opportunity zones. They're expecting to curtail that as well. Getting toward the end here, 11th, similar to real estate taxes, imposing an annual wealth tax requiring the payment of some percentage of one's wealth assessed on the value of all assets that you own. Interestingly enough, there are no numbers that have been discussed here. So I kind of wonder what that looks like. And then finally, number 12. Will it affect the middle class? I'm not sure. Number 12 is limiting the size to which an IRA or other retirement accounts may grow and or assessing penalties to accounts which exceed such limits. Sorry, Mr. Good Sir, you're doing too good of a job saving for your future and investing for your future. So if your IRA becomes too large, we're going to penalize you for having done too good of a job saving for retirement. So, that's where we're at. That's where we're at with these kind of things. Again, no numbers given there. And maybe when it gets implemented, maybe it'll be on something that's kind of outrageous for most normal people. Maybe they'll come out with a number that's $5 million, which probably won't affect a large portion of the population. But every time the government implements these kind of laws, isn't it a slippery slope? Isn't it just kind of like the camel getting its nose under the tent flap? Like, well, it's just on 5 million. But then a decade goes by and the country's even more in debt. Pensions are broke. Social Security and Medicare are insolvent. Well, we got to lower that 5 million down to 3 million. And then it affects more people. And now the camel's got his whole head under the tent flap. And then a few more years go by and, we've had some natural disasters and states are going broke and cities and municipalities are going broke, whatever the case might be, right? I'm just making stuff up as we talk now. But now the camel's got his neck under the tent and he's got his first hump under the tent as well. So it's just slowly the government implements one thing, but it's a slippery slope. And everybody says, oh, that's not going to affect me. No big deal. Go ahead, let them do it. It's just going to affect the wealthy. But it's a slippery slope, and they start slowly eroding away our freedoms and slowly confiscating our wealth through taxation and rolling it downhill slowly but surely. In fact, there was just a Wall Street Journal article that came out, and I know I've shared it on social media, where it says during the campaign trail, Biden said that this new tax hike is only going to affect taxpayers making $400,000 or more. Well, the Wall Street Journal article, it came out and it said after inspecting this, it's actually going to be half that. It's actually going to be half that. So they tell you one thing, but it's actually much worse. It's half of that $400,000. Those families are going to be impacted. And again, it's a slippery slope. Maybe you're sitting there thinking to yourself, well, I don't make $200,000 or my household doesn't make $200,000. But if it's a slippery slope, maybe in 5 years from now, maybe it's $150,000 and maybe that does affect you. Or maybe 10 years from now, it's $100,000 that you're going to see more taxation. And maybe at that point, it will affect you. So I think the first thing that we can do if you want to, if you're interested in avoiding some of these problems, number one would be to vote correctly, right? Vote for free markets, free enterprise, freedom, for capitalism. So number one would be voting correctly. But some of the other things that I could recommend is, the second thing would be get out of bad debt. Get out of bad debt. Because if they do raise tax rates on you, all of a sudden that $30,000 in credit card debt you have, all of a sudden now that $30,000 is going to feel like $50,000 because they're taking more of your money through income tax. And right now we're seeing more inflation than we have in quite some time. Ask any builder who needs to buy lumber what that inflation feels like. So if you're actually seeing less income in your paycheck because of higher taxes, and the value of the dollars that you have left won't go as far because of inflation, that $30,000 in credit card debt, now it's going to feel like $50,000 or it's going to feel like $60,000. So that would be, my second thing is to get out of bad debt. And I don't mean necessarily your mortgage or your auto loan, especially because interest rates are so low on those things and everybody needs a house to live in. Most people need a car to drive. Now, it doesn't have to be a Lamborghini or it doesn't have to be a $100,000 Escalade. But I'm just talking about like the really consumeristic debt that all of the marketing and all the commercials, they lure us into like, oh, I need this hot, shiny new object this week. Because let's face it, we can go without a lot of those things. And again, as I'm saying this, I'm not picking on anybody specifically. I'm not picking on any one of those things specifically. If you can afford an Escalade and it doesn't destroy your family's finances and budget, great, go ahead and do it. But I'm just talking, again, general principles. Next thing, as it comes to your retirement income, if they're talking about all of these taxes that they're going to implement on us in the future, and they're going to raise tax rates, why in the world would you max out your 401k and max out your IRA and take your tax deduction right now in a historically low tax environment and then defer the income taxes to the future, where when you withdraw that money 10 years down the road or 20 years down the road, you're very likely to be in much higher tax brackets at that time. Because remember, everybody thinks a 401k is tax savings, and it's not. A 401k is tax deferral. You're taking a small tax deduction on a relatively small amount of money, being your monthly contribution right now, and then you're building up this big pile of money that's never been taxed before. And then when you withdraw that money, you're going to have to pay the tax rates at the time when you make the withdrawal. Now, most people have been told over and over, well, you're going to be in a lower tax bracket when you retire. Well, guess what? Over the last 15 or 20 years, we have found that to not be true. We have found that to not be true. Why? Because if you have done even a respectable job of saving, but you're saving all of that money in the 401k, all of that money that you're taking out, it becomes a taxable distribution. It's taxed as ordinary income. Okay. But A person who's retired has generally killed all of their tax deductions, because if their mortgage is paid off, no more mortgage interest deduction. If their children are grown, they get no more deductions for tax credits or childcare or anything like that. Retirees, generally, they're volunteering their time instead of giving money once they retire. And time is not a deductible resource or a deductible contribution. So there's a lot of things that change when somebody ends up moving into retirement. Here's another thing that people don't understand. Your 401k and IRA distributions can trigger a taxation on your Social Security benefits and trigger a surcharge tax for your Medicare premium. And because both of those programs, being government programs, because both of those programs are severely underfunded and they're on the brink of insolvency, I just fear that they're going to continue to lower those thresholds that will trigger taxation. So if you're pulling all your money out of a 401k that's classified as ordinary income, I just feel that you're going to end up paying more back in income tax. And it gets into this discussion where it's a little bit of a paradigm shift, where a larger account balance doesn't always necessarily mean more retirement cash flow. And that's a paradigm shift. Just because you have $1 million in your 401k doesn't mean you're going to have a higher cash flow, because on your distribution, after you pay your federal income tax and your state income tax and your local income tax and the taxation on your Social Security benefits and maybe your Medicare surcharge tax, if you trigger that, and your advisor fees, you actually have less spendable income than if you had $700,000 in a life insurance policy or $700,000 in a Roth IRA. So some of the things that you can do to protect yourself, third thing going on, so we talked about voting correctly. We talked about getting out of bad debt. Third thing is repositioning your retirement assets from the pre-tax or tax deferred bucket and moving it over here and giving yourself some tax-free buckets like your Roth accounts and your life insurance. Okay. So those are some of the tips, again, general education, just generally speaking, that I could give you, where then you want to work with your financial advisor or work with me in order to implement each of these strategies into your own personal plan, where you're at right now, with the goal of maximizing your net after-tax spendable cash flow, not just right now, but also for your future self as well. So I'm going to link this wealth management article here below today's recording. And that's all that we've got time for here today. So again, I hope that it helped. And that's today's rant. As always, thanks for listening.